Iraq Now reports.
Welcome to Iraq Now. We are pleased to present this report about the energy markets, in particular, the trend of the West Texas light crude oil price.
West Texas Intermediate and WTI crude oil to reach $200 per barrel in the coming years. The convergence of technical and fundamental analysis points to a new super bullish cycle. Research and analysis by Dr. Sabi Jabara. December 30th, 2025 Introduction. The global crude oil market stands at a critical juncture where a compelling technical pattern aligns with profound structural shifts in supply and demand. Analysis of the daily chart for West Texas Intermediate, WTI, interpreted through Elliott Wave Theory, indicates that a multi-year corrective phase is nearing its end, paving the way for a strong and sustained upward trend. This technical catalyst, specifically the anticipated start of a major Wave 3, is strongly supported by fundamental factors, including a chronic global investment shortage and ongoing geopolitical risks, which together point to a potential price target of $200 per barrel in the coming years. Technical analysis. Completion of Wave 2 and launch of Wave 3. Elliott Wave Theory posits that market prices move in recognizable patterns, driven by investor psychology. The current analysis of the daily chart for West Texas Intermediate crude oil indicates that the market is concluding a significant, multi-year corrective phase, designated as Wave 2 of a larger trend. As the chart shows, the price movement has been characterized by a complex, multi-level decline, which appears to be nearing its end close to critical Fibonacci retracement levels, specifically the 61.8% area, corresponding to the $48 to $52 per barrel range. This corrective structure, characterized by internal waves, I, hast, Schurstas, I vi, and vi of a larger zud correction, is a classic pattern for the completion of Wave 2. The significance of the completion of Wave 2 lies in its role as the starting point for Wave 3. Historically, Wave 3 is the most dynamic and extended impulse wave within a 5-wave sequence, often exceeding one wave's length. Given the magnitude of the previous decline and the multi-year nature of the pattern, the subsequent Wave 3 is expected to be a super-cycle move. The projection to $200 per barrel from the expected low of Wave 2 at around $50 per barrel represents a 4-fold increase, a magnitude consistent with historical commodity supercycles driven by sharp imbalances in supply and demand. Therefore, the technical setup provides a clear trend signal and a strong framework for a long-term bullish trend. The fundamental background: an impending supply crisis. While the technical picture provides the timing, the underlying reality provides the fuel for a sustained surge of this magnitude. The primary driver is a chronic, multi-year underinvestment in global oil production capacity, a structural weakness rapidly approaching a critical tipping point. An industry analysis reveals a significant and persistent gap between the capital required to maintain global production and the actual spending by energy companies. Nearly $5 trillion in investment is needed over the next 5 years to maintain sufficient production capacity. Current global spending on exploration and production hovers around $600 to $700 billion annually, creating an annual shortfall of $300 to $400 billion against the estimated $1 trillion required. This cumulative shortfall is projected to lead to a massive $5 trillion supply gap by the 2026 to 2027 timeframe. This underinvestment is not due to a lack of geological resources, but rather to a fundamental shift in capital allocation. Due to environmental, social, and governance, ESG, mandates, and investor pressure, major oil companies now allocate 60 to 70% of their free cash flow to shareholder returns, dividends, and share buybacks, rather than production growth. This shift, coupled with regulatory uncertainty and cost inflation, has essentially constrained the industry's ability to bring new supply to market. The perpetual investment cycle. Supply challenges are exacerbated by the high natural decline rates of existing oil fields, creating a perpetual investment cycle. Unlike manufactured goods, which depreciate slowly, oil production requires continuous capital investment just to maintain production levels. The rapid decline of short-cycle, high-volume shale oil wells further aggravates this problem, forcing the industry to drill more and more wells simply to stay in place. Demand and supportive geopolitical winds. These supply-side constraints come against a backdrop of strong long-term demand, particularly from emerging economies. The Organization of the Petroleum Exporting Countries, OPEC, remains firmly convinced that global oil demand will continue to grow, projecting it to reach 113.3 million barrels per day by 2030, and seeing no peak demand on the horizon. While the International Energy Agency, IEA, is more conservative due to the accelerating adoption of electric vehicles, its forecasts also acknowledge that without significant investment, the supply side will be unable to meet even modest demand growth, leading to a sharp mismatch between supply and demand. Growth in the petrochemicals, aviation, and transportation sectors in emerging markets like India and Southeast Asia remains a strong and involuntary driver of consumption. Finally, the persistent geopolitical risk premium cannot be ignored. Continued instability in the Middle East and Eastern Europe ensures that a significant portion of global oil supplies remain vulnerable to disruption. Any major supply shock in this environment of low spare capacity and depleted inventories would immediately trigger a sharp price spike, accelerating the move toward the higher price zone predicted by technical analysis. Summary: the convergence of technical and fundamental indicators paints a compelling picture for the future of crude oil prices. The completion of the Elliott Wave 2 correction provides the technical signal for the start of a strong, multi-year advance in Wave 3. This move is primarily supported by a structural supply crisis, the $5 trillion investment shortfall, which guarantees a tightening of market balance in 2026 to 2027. When the technical launch of Wave 3 coincides with the fundamental reality of a severe supply crisis, the path of least resistance for WTI crude will be sharply upward, making a target of $200 per barrel a highly probable outcome in the coming years.